So cost segregation is when you own a piece of investment property. So it has to be a revenue generating property. It doesn't work on your primary residence. But when you own a revenue generating property or an investment property, the IRS allows you to take a non-cash expense every year called depreciation. That depreciation for residential units, so anywhere where somebody lives, that depreciation is calculated over 27 and a half years. For any commercial building, that depreciation is calculated over 39 years. So just to make the math easy, Nate, let's say I buy a $275,000 single family home. That's going to get depreciated over 27 and a half years. So you take 275 divided by 27 and a half. That's a $10,000 write-off every year for the next 27 and a half years, which is great. That's why a lot of us get into real estate. Well, what if I can accelerate that? I'm not going to own my properties, Nate, for 27 and a half years. I want my deductions now. And so that is where cost segregation comes in. And just as the name implies, we're going to segregate the cost of that building into different asset classes. So, for example, when you buy a single family home, you're not just buying the land and the walls, you're buying a bunch of appliances. You're buying some flooring, you're buying some cabinets, you're buying a driveway. All those things I mentioned, the IRS says they depreciate over a shorter useful life than 27 and a half years. That's cost segregation at a very high level. Just as the name implies, we're segregating the cost of your building. Now, let's talk about bonus because bonus puts cost segregation on steroids. So we were doing cost segregation before there was bonus, and we were, moving stuff from the 27 and a half year bucket over to the 5 year bucket. But in 2017, with the Tax Cuts and Jobs Act, and so two things changed. One is bonus depreciation came at 100%. So what bonus means, bonus depreciation, is the government uses bonus depreciation to stimulate the economy. They want to incentivize people to go out and buy stuff. In order to take advantage of bonus, your assets have to have a useful life of 20 years or less. That's key. Otherwise, you don't get bonus. So I've actually met with tax preparers, Nate, where they're like, well, bonus doesn't apply to real estate because real estate's a 27 and a half year asset. Well, yes, CPA, it is until you do a cost segregation study and you break that 27 and a half year asset up into 5, 7, and 15-year buckets. And now all of a sudden, those 5, 7, and 15-year assets are eligible for bonus because it makes a huge impact. Remember, those 5 year assets, you get 100% of those deductions in year one, as opposed to spreading them out over 5 years. So, like I said, it puts cost segregation on steroids when we can apply bonus depreciation.